Good afternoon. Welcome to Capital Account. I'm Lauren Lister here in Washington, D.C. These are your headlines for Thursday, October 4th, 2012. Gold hit an 11-month high today, allegedly bolstered by signs the ECB will keep its borrowing costs low and stands ready to buy bonds. Now, as long as central banks continue to print and maintain negative real interest rates, should investors consider owning gold? Well, we're seeing that question answered with a yes from the darndest places. We'll talk about the impact. However, you may have also seen this story all over the blogosphere recently about a New York merchant.
He heard counterfeit gold bars were going around, so he drilled into several of his gold bars worth about $100,000 and saw gray tungsten.
Does fake gold really represent a tail risk for buying physical gold, or is this a one-off thing? We'll speak to Mark O'Byrne of the international gold bullion dealer, GoldCore. And though we tend to favor market solutions for most things, are market forces actually doing a disservice to democracy in the case of the presidential debate coverage? We'll talk about it in Loose Change. Let's get to today's Capital Account. Some of the headlines today range from gold rises on ECB rate decision beforehand to gold prices were higher as the ECB president Mario Draghi said the ECB was ready to buy government bonds. Isn't that what he's been doing all along? Regardless of what you think of what the animal spirits, which ones are driving markets at any given moment, one often heard argument is that as central banks around the world print, gold rises as people hedge against the sure-to-be inflation and currency debasement. And we have precious metals investors on the show who advocate owning gold for reasons such as this. And we've certainly seen the gold prices rise over the last 12 years. But still, a very small percent of global investments are allocated to gold. It hasn't gone mainstream. However, you can take a look at the prices and how they've risen there over the last 12 years. Despite this, gold is not a mainstream investment, but look at this, a report from PIMCO in October that has been making the blogosphere rounds. I'll quote from it. They say, we believe investors should consider allocating gold and other precious metals to a diversified investment portfolio. The supply of gold is constrained, and we see demand increasing consistent with global economic growth on a per capita basis. Regarding inflation in particular, we feel that the Federal Reserve's decision to begin a third round of quantitative easing makes gold even more attractive. PIMCO is advocating investors buying gold. So could this mean gold's going to move mainstream? And in an era of fiat money printing, one of the appeals of gold is that it is no one else's liability. It's a hard asset. But this story came out last month and really shook up the blogosphere.
In jewelry stores on 47th Street and 5th Avenue, the important trust between merchants has been violated. This 10-ounce gold bar costing nearly $18,000 turns out to be a counterfeit. It's filled with tungsten, which weighs nearly the same as gold, but costs just over $1 an ounce.
Well, fake gold isn't a very good investment, so is this a real risk? We spoke about all of this earlier with Mark O'Byrne. He's founder and executive director of the international bullion dealer GoldCore. We spoke first about the role of gold. One conventional wisdom, I would consider it, is that gold is a hedge against inflation. But there's the question of what degree of inflation. If we bring up a chart of gold prices from the 1970s to today, you can see that gold doesn't really function as a hedge against moderate inflation. I mean, the gold price went down during the 90s. We saw moderate inflation. Where it seems that gold comes in as a hedge is against massive inflation or massive credit stress, as in some kind of dislocating deflation, as we saw during the 70s, and kind of as we see now with this risk-on, risk-off concern, where people are worried about massive inflation or massive deflation. So how do you see gold as a hedge?
Well, yeah, I think you summed it up fairly well there. It's not a hedge against moderate inflation per se, particularly of moderate inflation and benign economic growth and reasonably good economic growth levels. And that was seen obviously very clearly in the 1990s. Where gold tends to do well is when you have deflation, when you have stagflation, and when you have virulent inflation, and obviously in the worst case scenario, in hyperinflation. So deflation, obviously we saw that in the 1930s and after the Wall Street crash in 1929. There was a massive deflation and stock markets came off very, very sharply, as did property markets. And the dollar was devalued in effect by 70%, and gold was revalued by 70%, from roughly $20 per ounce to $35 per ounce. And that was, one of the most deflation events in the history of mankind. And then again in the last 5 years, with the so-called credit crunch and Bear Stearns and Lehman Brothers and those quite significant deflationary periods for a very short period of time. Particularly, it was more asset class deflation that we saw. The price of food and energy didn't come down a whole lot. I mean, commodities did come down a bit for a period of time. But again, gold, while it was correlated with equities in the very short term, gold based a lot sooner than equities, and then it started rising sooner than equities as well. So again, showed the inverse correlation with risk assets such as equities and bonds. And then the stagflation in the 1970s is when we saw the last bull market in gold. We had double-digit inflation over 10% for a number of years, and the gold price rose from $35 to $850 in just 9 years. So you're right. Yeah, it's basically a hedge against deflation, because gold is the only asset class that cannot go bankrupt. Unlike every single company and every single government in the world, there is counterparty risk with these with paper assets such as bonds and equities. Whereas gold, there is no counterparty risk if you own it in the safest way possible. So that's why it's a hedge against deflation. And in regards to inflation, it's because gold is so finite, and economics is quite a simple thing, and sometimes it gets convoluted and complicated by PhD economists.
Yes.
And the mass of people can't understand it. But economics, in its most simple term, is about supply and demand.
Okay.
And gold is extremely, extremely rare. I would say not one person in 100 million people know how much gold is in the world. And the fact is that all the gold in the world, if you made it into one giant gold bar, made it 0.9999 pure, so 24 carat gold, one giant bar would basically fit in the centre court of Wimbledon, just down the road here.
All right.
So it's extremely, extremely rare. And meanwhile, the money supply is anything but rare, and the Federal Reserve has pumped in, the Federal Reserve alone has pumped in $2.3 trillion just in the last
That's for sure. Mr. O'Byrne, I want to get into to dive into a few of the aspects you're talking about, because you've touched on a number of things that I want to get to before this interview ends in 5 minutes, because that's the time that we have. So first, if you look at total credit market debt, there is a ton of credit market debt. And if there's a major deleveraging event, as we've just discussed, perhaps gold would perform well. But also, gold, you would expect downward pressure on the gold price as people sold off their assets in order to pay down the debt. So how would you expect gold to perform in a major deleveraging? And do you see any kind of major deleveraging event that could potentially be on the horizon?
I do, actually. I think it is quite possible, especially given the facts that you outlined there. There is a possibility of another Lehman-style moment and huge volatility in marketplaces and sharp falls in equity markets and stock markets. And in that scenario, then there is the potential for gold to fall as well, and have another correction in what we believe is a secular bull market. But we do believe, again, it would be a correction within a secular bull market, and gold in that scenario would most likely, what would happen is, as you said, the more speculative players would basically, they would deleverage. So people on the COMEX who are trading paper futures in a leveraged fashion, hedge funds and more speculative players, prop techs of banks, and that they would basically go to the safety, the so-called safety, or relative safety of cash or US Treasuries, and that would see the gold price fall in the short term. But then I suppose the more fundamental demand, and it would actually increase physical demand, that would create the floor under the price, and then the price will recover quicker, I would think, than stock markets and the bond markets would recover in that scenario.
Okay, got it. So then would any time in there be a time to buy, because you believe gold is still in a secular bull market? Yeah, okay. Yeah,
well, again, buy the dip, and I mean, the 200-day moving average, the 100-day moving average have been good places to buy in the last 10 years, and I think that will continue to be the case. With the election now coming up in early November, don't think actually October is normally quite a volatile month, and we've had a number of crashes in October. But I think with the election coming up in early November, I don't foresee any great dislocations until after the election.
Okay.
But who knows? It's a very uncertain time out there. And October, traditionally, October is actually quite a negative month for gold.
Okay.
So if you are trying to time things, we tend to tell people not to try and time it. But if you were going to try and time it, possibly you'd wait till the start of November.
Okay, so some seasonal issues at play there historically. I want to ask about the supply, because you mentioned gold is rare, and there is this story that's blown up on the blogosphere to an extent, a report of fake gold that a merchant in New York was sold. It was filled with tungsten. He found that out after he had heard from a friend that was a merchant that they'd received a gold bar that when they drilled into was salted with tungsten. Now this, I think, incites some anxieties in people, especially people that think of gold, physical gold, as something they can hold outside of the financial system in an allocated vault, maybe even in their garage. So you are a bullion dealer. What is your experience with this? Is this a risk that people actually need to be concerned about, or is this a one-off freak thing?
Well, yeah, right now it's a one-off freak thing. It's extremely, extremely rare. And I mean, we're in the industry at the coalface, and we've never come across it, and nor have any of the counterparties that we deal with. So there's been a handful. I don't even know. I think it is literally a handful. I think it's 4 or 5 tungsten gold bars that have been found. They're 10-ounce bars. So I mean, the global gold marketplace, I mean, there's every year there's hundreds of thousands of bars and coins produced, if not millions, in different formats: 1 ounce, 10 ounce, 100 ounce, kilo, 400 ounce bars, and basically there's been a handful of 10-ounce bars found. So that's not to say, who knows? In time, as the price of gold goes up, there's likely to be forgeries. So what you have to do to protect yourself is, I suppose, deal with established and reputable bullion dealers, and I suppose deal with people who are buying more rather from the secondary marketplace and from the public. They're buying more directly from source. So if you're buying directly from a bullion dealer who buys directly from a government mint or from a refinery, then you lessen that risk. Okay.
There's also and Mr. O'Byrne, before we go, I have to ask you this. I have to ask you this question, and if you get cut off, please forgive me. The window's about to close, but I have to ask. PIMCO is now recommending that people buy gold. Could this be a turning point in mainstream allocations to precious metals?
Yeah, well, the Bill Gross thing, his talk of ring of fire and bonds is I think it is a huge development. And it's gradually moving into mainstream, but it's still a fringe investment, and it's owned by a tiny minority of people own any allocation to gold whatsoever, and only a tiny, tiny percentage of that amount of people have an allocation to physical gold, whether it be in an allocated format or have taken delivery into their garage or wherever they store it, as you suggest. So it's going from the fringe gradually, and it will enter the mainstream, I think, in the next 3, 5, 7 years.
There you have it, a prediction, and still ahead, the paradigm shift in the gold market brought on by central banks, and it doesn't involve money printing. We'll hear what it is from Mark O'Byrne after the break, but first, your closing market numbers.
Here's Mitt Romney trying to figure out the name of that thing that we Americans call a donut.
I'm sorry. I'm just a guy who cares an awful lot about my country.
You, sir, are a fool. You know what? That is mine.
Are there terrorist cells in your
Far
neighborhood?
left does not want the USA to defeat terrorism.
You cannot be a liberal and a Christian.
Republicans lie.
It's really so stupid.
You know, the corporate media distracts us from what you and I should care about because they're a profit-driven industry that sells us sensationalistic garbage and calls it breaking news. I'm Abby Martin, and we're going to break the set.
Welcome back. We're talking about precious metals, and this statement struck us from PIMCO's October note. To go back to it for a moment, another way to think about the relative value of gold is to consider what a return to the gold standard might look like. Given that there are 155,000 metric tons of gold above ground, this equals an approximate price of $2,500 per ounce if all the world's reserves are to be backed by the entire stock of above ground physical gold. Now, PIMCO uses this to indicate that the gold valuations aren't as high as their nominal price would suggest, but is it just me, or is it just bizarre to see PIMCO talking about a return to a gold standard? Now, regardless of whether central banks are considering a return to some kind of a gold standard, they are becoming net buyers of the yellow metal. And it could be proof that they see it as a real store of value. I spoke to GoldCore founder Mark O'Byrne on the impact. Take a look. Reportedly around this time last year, European central banks became a net buyer of gold. We've seen emerging market central banks loading up on gold, although there is some indication that perhaps in August major players stayed more on the sidelines, perhaps because gold prices rose. So I'm curious what impact this has, central bank buying, on gold prices. Has there been a floor created? In other words, a price that central banks will always step in to buy?
Yeah, I think that is increasingly the belief in the marketplace among more astute analysts, because it's a paradigm shift. Central banks were net sellers for nearly 40 years, and they've gone from being net sellers in the marketplace to net buyers. So far, in the first half of this year alone, they've bought some 254 tons, and that's just official purchases that we're aware of countries that are reporting to the IMF. There's most likely some unofficial purchases going on as well from the likes of China. And the World Gold Council believe that by the end of the year, 500 tons will be bought by central banks this year. So it's a huge shift, and it's quite a sustainable shift as well, because while the tonnage amounts seem quite a lot in dollar terms or euro terms or sterling terms, they're not actually that much, especially when compared to the amount of money that's been created in the world today. So yeah, it's always dangerous to talk about paradigm shifts, but it's a fundamental change in the gold marketplace that is very, very important, and I think it's still yet to be fully appreciated.
Interesting. So just, I don't know if there's any number you've heard. Is there any kind of number that you know of that you think is a floor in terms of gold prices with this paradigm shift?
Well, it's hard to know, and it's always very dangerous to get into predictions regarding floors or even predictions about where the price will go. But it does seem, just looking at the buying patterns and even a bit of rudimentary technical analysis, that around the 1,500 to 1,600 ounce level, there does seem to be very strong demand at that level. And central bank demand is just one facet. I mean, there's broad-based global demand. The central bank demand is quite an important one because they've gone from net sellers to net buyers, but it is just one factor as well. And these other factors, whether it be Chinese demand, obviously the fact that Chinese people couldn't buy gold from 1950 to 2003 because Chairman Mao banned gold ownership, that's another fundamental factor that is not appreciated by the wider marketplace. And I think those two factors are actually very, very important. And I think the Chinese buyers, in time, I think they will become a little bit like the Indian buyers, who are quite price sensitive, and they will tend to buy on dips. And I think they will fundamentally support this marketplace in the coming years.
That's interesting. I want to continue on that, because the broader trend you're talking about is that these countries have been buying gold, but recently we've seen a significant slowdown in demand from China and from India, perhaps because their economies have weakened. So if their economies continue to weaken, could you see this major driver of demand not being there to the extent that perhaps you or others are expecting?
No, I wouldn't think so. And there is some speculation that may transpire, but I wouldn't think that is the case, because if their economies slow down, and you're seeing it quite significantly in China already, their economy has slowed down quite a bit already. Their stock market has come off very, very sharply in recent months, and indeed their property markets in different cities around China are beginning to fall. So I think in that scenario, the Chinese people, they have an experience of hyperinflation within the lifetime of many Chinese people. I think it was 1949 they had hyperinflation. So they're quite a little bit like the people in India. They're quite distrusting of paper currencies, and therefore, if their economies slow down quite significantly, it would mean that you would see less, I suppose, jewelry demand and demand for, I suppose, basically jewelry and fashion accessories and all the rest. But I think you would see increased bar demand and indeed coin demand because of economic uncertainties in their domestic economies. And the policy response to a slowdown in economic growth in China and India may well be similar to the policy response we're seeing in the Western world, which is ultra-loose monetary policies, absolutely unheard of in modern times. And these ultra-loose monetary policies and basic currency debasement are set to continue for the foreseeable future, both in the Western world and indeed they may be seen in these developing markets.
There you have it, a gold roundup from Mark O'Byrne, founder and executive director of GoldCore. All right, let's wrap up with loose change. Let's talk about a market angle on the market for presidential debates, because more than 58 million people tuned in for the first presidential debate. It was last night. That was according to TV Newser. Fox News was the most watched cable news network, beat out both MSNBC and CNN and the broadcast news networks. Now, the cable news networks also brought in millions of viewers for their pre- and post-debate analysis. Let's just look at a roundup.
It was a pretty substantive debate. I don't know that we learned a lot new, those of us who've been watching this so closely.
In the first 30 to 40 minutes seemed to make some significant points. President Obama in that same time didn't seem as energetic and seemed defensive at points.
It does remind you that the last debate that Mitt Romney had was 7 months ago, and the last debate that Barack Obama had was 4 years ago. And the people who he's used to sparring with are reporters who are asking him questions from a seated position as he stands at election.
The president actually spoke for a little bit more than 4 minutes, more than Mitt Romney spoke. 42 minutes and 50 seconds for the president, 38 minutes and 32 seconds for Mitt Romney. This was a pretty good night.
How did he prepare? How did the president prepare for this?
It was an interesting dynamic to see Mitt Romney looking mostly over at President Obama when he was making his points, and President Obama choosing to look mostly at Jim Lara or looking down.
Compelling news. That is breaking news where their eye gaze was directed. So the question that arises is what I will hand over to Dimitri to pick up on, which is what you were talking earlier today, which is you don't believe that the market demand is conducive to democracy when it comes to this election coverage.
Well, I was saying, well, we were disagreeing about whether this is in fact the case, that they actually do focus on the horse race over the substance. But that aside for a second, what I'm saying is that the bottom 50% of the country is not very profitable for advertisers. All right, they don't really care about them that much. They'd rather them just go away. They'd rather deal with more and more affluent demographics. So the only people that, well, all I'm saying is, who really cares about the horse race? Only people that can have the luxury to watch politics as a sport would actually, and not care about the outcome, focus on what did Mitt Romney do with his hair that day? Did he have a stand-in double? Did he get punched in the face before he went out on television to warm himself up? Did he dunk his head in an ice box? I mean, who else cares about that but people that really have nothing to lose?
Let me play the devil's advocate, and I have a feeling our audience is going to agree with you wholeheartedly. So, folks, be nice to me, because I'm just playing the devil's advocate.
So you got an opportunity to make your case.
No, but Dimitri, okay, all of those things, okay, how a candidate prepares, how they consider this, what they do, what their character is like, that reflects on their character. Don't you think it's important to voters to know the character of the men that they're voting for?
I disagree.
Possibly?
I think that's like, for example, and I used this example, this thing before when we were talking. It's like focusing on how do you prep for the SAT as opposed to focusing on what does the SAT show about your intelligence.
Well,
we're trying to figure out.
Okay.
Yeah, but I'm saying I don't care about how they're doing. What I'm saying is I don't care about how they're preparing to trick me. I don't care about how good they are at being slick salesmen. I want to know what they're selling me, not if they're how they figured out how to sell me and dupe me.
Okay.
You know what I mean?
Well, Dimitri, you before have argued that something like the SAT and standardized tests are dumb. They don't accurately reflect intelligence or capability. So isn't it important to actually know how a student would prepare for the SAT? Wouldn't that arguably tell more about their character or their drive or their ambition or their focus to know how they prepared for that test versus necessarily how they performed on it?
No, because that's not the point. Because the point of this is not to know how good Mitt Romney, how good of a debater Mitt Romney is. You're supposed to figure out. You're supposed to make a decision about the president of the country. You're not supposed to care. You're not making a decision about who the best debater in the country is. If this was
then
like,
who
if this
cares
was the
about the
finals,
debate at all?
If this was the finals of the debate of America's top 2 debaters, then yeah, this would be perfect. This would be perfect coverage. But no one. It's not about being the top debaters. It's about who is actually going to.
Dimitri, did you watch post-election coverage?
I was playing
post-debate
Tetris.
coverage?
I was playing Tetris.
You were playing Tetris after the debate. So how can you accurately size up what the analysis was afterwards? Because there was analysis of policy issues afterwards, especially on MSNBC, where they were all like upset with how Obama performed. So they were trying to make up for it with all of the policy issues that they wished that he had brought up.
Excuse me, were you not listening? You must have been paying Tetris when we were playing that video.
No.
Because that video was all stuff like that.
And you know what? The video was for TV to make your point. So this is all focused on your point. Your point is subsidized.
Right. I can't.
Mine is the free market perspective.
It's ridiculous. I don't agree with you. But anyway, do we have time?
Let's move on. Let's do another story.
Let's try it.
Because it's been a rough few months for Facebook, but they have finally reached 1 billion users. We all know that lots of people spend too much time on the social media site. Not I, because I'm not on there, although now Capital Account is. And that their emotions depend, people, users, on what happens in the virtual world. But MIT has developed a jacket that further proves the point, which will associate virtual likes with a real hug. Check it out. Okay, this is pathetic. Get a friend, people. Get off of Facebook and make one. That's what I have to say.
I think Mitt Romney should get one of those vests and literally click himself to death with the like button.
Why?
Because he desperately
likes himself enough.
He needs friends and he needs hugs, and he should join one of those cuddle clubs in Japan.
Dimitri,
we heard about cuddle clubs. They should bring him here to the U.S. to get Mitt Romney to
let me just
cuddle.
say something. If Mitt Romney won last night, and if Fox News got the most viewers, which means that Mitt Romney basically won twice, then I don't think he needs the hugs right now. I think if anybody in the race needs the hugs, it would be Obama. But we gotta go. I gotta leave it there.
Of course, you get the last word.
As usual, that's all we have time for. Thank you so much for watching. Have a great night. And in the meantime, until tomorrow, you can follow me on Twitter at Lauren Lister. You can like us on Facebook, Facebook.com/Capital Account. Watch us in YouTube, Hulu. Thank you for watching. Have a wonderful night.